You're making money, you're paying your bills, saving a little, but now you're wondering, where do I even start with investing? The concept of investing can be scary, especially if you've not been taught much about money. Building wealth is actually simple, but it's not necessarily easy. We can, though, look to examples on how to do it by studying wealthy people. Warren Buffett is worth over $130 billion, and he didn't get rich by chasing trends, timing the market, or day trading from his phone. He followed a few simple, powerful investing principles and stuck to them for decades. In this video, we're breaking down 5 ways you can invest like Warren Buffett, no matter your income level. These strategies don't require a finance degree or a Wall Street connection, just patience, discipline, and a long-term mindset. So let's dive in. Number 1, buy businesses, not stocks. Buffett doesn't see stocks as just tickers and numbers on a screen. He sees them as ownership in real companies. His advice? Buy a business, not a stock. Before he invests, he asks, would I want to own this business if the stock market shut down for 10 years and I couldn't sell the stock? That changes everything because instead of chasing stock prices, you start looking for companies with a solid product people love, consistent earnings, and a competitive edge that can last for decades. For example, Buffett didn't just buy Coca-Cola because the stock was trending. He bought it because he believed in the brand, the product, and the business model, and he's held it for over 30 years. This mindset helps you stop thinking like a gambler and start thinking like an owner. If you're not sure where to begin, start by learning about companies you already use every day, like Apple, Nike, or Amazon. Read their annual reports. Look at their products. Would you want to own a slice of that business for the next 3 decades? Number 2, invest in what you understand. Personally, we think this is one of Buffett's most underrated pieces of advice. Never invest in a business you cannot understand. When you're new to investing, it's easy to feel pressure to jump into complex industries like crypto or even AI startups. But if you don't understand how a business makes money, you won't know what makes it succeed or fail. Buffett calls this his circle of competence. He sticks to businesses he knows well, like insurance, railroads, banking, and consumer products. He doesn't chase what's trendy, he sticks to what he understands. Most recently, we've seen this play out during the 2021 to 2023 NFT and meme coin craze. Many individuals lost their life savings chasing after big bucks, speculating in NFTs and meme coins. Don't invest in something just because someone on social media said it's the next big thing. If you can't explain it to a 10-year-old, you probably shouldn't put your money into it. If you're just getting started, keep things simple. Now, we can't tell you how to invest, but you could look into investing into funds and ETFs because you understand how a lot of those businesses work, places like Spotify and Starbucks. Perhaps you invest in real estate because you already own a home and understand the costs and maintenance associated with such an investment. Don't chase hype. Clarity beats complexity when it comes to investing. Number 3, be greedy when others are fearful. This may be one of Warren Buffett's most famous quotes. Be fearful when others are greedy and greedy when others are fearful. Here's what that means. Most people panic when the market goes down, but Buffett sees crashes and corrections as opportunities. You must understand that recessions and down markets aren't anomalies. They're part of the economic cycle. Don't panic during market crashes. Prepare for them. In 2008, when the housing market crashed and the financial world was on fire, Buffett went shopping. He bought shares in strong companies at a huge discount because he knew fear was temporary, but value lasts. In 2020, markets tanked almost overnight. Everyone was scared and rattled, but Buffett looked for solid companies selling at a discount, and he bought more of them. We understand that, especially if you're closer to retirement, down markets and unpredictable market movements can be unnerving. But your greatest superpower as a younger investor is time. When the market drops, you've got decades ahead to recover and benefit from the rebound. If you're an older investor, you should be strategically moving to a position less volatile. And if you're feeling the squeeze during a down market, it may be an opportunity to look at your total portfolio and ensure you're taking the appropriate level of risk. So instead of freaking out during a downturn, you should be asking, is this a chance to buy something great on sale? Be very cautious about selling out of fear. Use those dips to your advantage. Now, before we get to the last 2 points, if you've made it this far into the video, thank you so much for watching. All we ask is if you've gotten any value, hit that like button and subscribe so you don't miss out on future content. Now let's get to those last 2 points. Number 4, hold for the long haul. Our favorite holding period is forever. Buffett's secret isn't perfect timing. It's time itself. When he buys investments with the intention of never selling them. He doesn't buy and sell based on headlines or just quarterly results. He finds great companies and lets compounding do the heavy lifting. An example, he's held Coca-Cola since 1988, and he's held American Express for over 25 years. If you invest $200 a month starting at age 25 and earn an 8% average return, you'll have over $600,000 by age 60. But if you try to time the market or constantly switch in and out of investments, you interrupt the compounding process and lose out on potential growth. The real wealth doesn't come from chasing hot stocks. It comes from consistency, starting early, investing regularly, and staying the course, even when the headlines look scary. Don't treat investing like a sprint. It's a marathon. And if you don't want to pick individual stocks, that's totally fine. Buffett himself recommends a low-cost S&P 500 index fund for most people. It's simple, diversified, and historically strong over the long term. Hold onto your investments for years, even decades. Ignore short-term noise and focus on long-term value. Let time do the heavy lifting. Number 5, focus on value, not just price. Buffett doesn't care if something is cheap. He cares if it's undervalued. He explains it like this: price is what you pay, value is what you get. In other words, he looks for companies that are temporarily mispriced, solid businesses trading for less than they're worth. The goal is to find quality businesses that Wall Street has overlooked or undervalued due to short-term noise. For example, you might see a stock trading at $10 and think it's a bargain. But if the company is losing money, has huge debt, and no growth plan, it might actually be overpriced. On the flip side, a company like Costco might trade at a higher price but offer strong cash flow, loyal customers, and predictable growth. That's value. The lesson here: don't just chase the cheapest stock. Learn how to spot companies that are solid, profitable, and reliable, but temporarily underappreciated by the market. You don't need to become a valuation expert overnight, but start asking basic questions like, is this company making money? Are they growing sustainably? Do they have a competitive edge? Learn the basics of valuation, but if that's not your style, you don't have to pick individual stocks. You can lean on index funds and ETFs that already contain a mix of high-quality, value-oriented companies. So here's our quick recap. Buy businesses, not stocks. Stick to what you understand. Don't panic. Buy when others are scared. Hold for the long run. Focus on value, not just price. Warren Buffett is touted as one of the greatest investors of our time, so his advice holds a lot of weight. If you're just getting started with investing, don't worry about being perfect. Worry about being consistent. Start small, start now. Let compound interest and time work their magic. Thanks so much for watching. We hope you learned something new today, and if you did, please share this video with a friend. Don't forget to hit that thumbs up button, and we'll see you in the next one.